Subscribe to our YouTube channel, Joy Learning TV.
Hello, I am so happy once again to be on your screens, and I hope you are too. It's yet going to be another fantastic moment on the Joy Learning channel, the SHS. Today on our lesson, we are looking at standard costing, which you have already looked at in our previous lesson. So I expect you all to know the meaning of standard costing. When we talk about standard costing, we said is a predetermined cost for a particular unit an organization will want to produce. So here our focus is just the cost for a unit. When we talk about budget, we are preparing a budget for a whole product, but this time when we talk about standard, we are looking at the predetermined cost for just a unit of an item. We also look at some of the types of a budget. We can have the expected, we can have the basic, and the current. These are just a few of the type of standard we have. Now today our focus is still going to be on how to calculate for the various variances. What are variance? We've already looked at this as well. If there is a deviation between the actual cost and then the standard cost a firm predetermined to purchase or sell a product, the cost. If I'm supposed to use a particular number of hours that I have predetermined, but the actual hours I used was more than the expected one, is there a deviation? Yes. And is this deviation negative or positive? Okay, if you're ready, let's walk through. Let's see how to calculate for the various variances of a firm. Now, you know what we are about today. So let's go through. If you are ready, let's look at some of the objectives of our lessons for today. So at the end of our lesson for today, you are expected to be able to define what standard costing is. As usual, it's going to be a revision because we have looked at this in our previous lesson. You should be also state the major classification of variance, because if you are not able, then what are you going to be calculating? You should know the various classification of a variance. And then finally, you should be able to calculate the various variances you have looked at. Once you get to know the classification, then we have to look at how to calculate for them. Now let's walk through if you are ready. So what is standard costing? As I made mention earlier, this is what we looked at in our previous lesson. We say standard costing is defined as the preparation and use of standard cost. When we talk about standard cost, it means a predetermined cost. Their comparison with actual cost, and then the analysis of variance to their causes and points of incidence. It is one of the techniques used to provide cost expectations per unit of an activity. So this is where our focus is going to be. Cost expectations per unit. So the focus here is what? Per unit. As I said, standard is focused on per unit of an item as compared to that of a budget, where we are looking at the whole product being produced. Good. So then, if you understand what standard is, what then is a variance? And I made mention that a variance occurs where our actual is more than our standards. So the variance can either be negative or positive. We have a favorable variance and then an adverse variance. So where our expected, that is our standard, is more than the actual, then it means there is a favorable variance, because what we budgeted for is even more than the actual we end up paying for. But in terms where the actual is more than the standard, as in the actual cost is more than the standard, then it means there is what? An adverse, because we have planned or estimated that the cost of the unit is going to be 1 cedi. for each unit we are going to produce, but the actual cost was 2 cedi. You get it? So it means there's going to be what? An adverse variance. There is a variance, but this variance is adverse because it's a negative adverse. Sorry, a negative variance. Adverse means negative. It's going to have what? A negative impact on the firm because we are going to end up paying more. If we expected to pay 1 cedi for a unit and we are going to pay 2 cedi, it means double the price. But if we budgeted for 1 cedi and the actual price is 50 pesos, that's a positive variance, right? Good. It means we can get 2 for the 1 cedi that we expected to purchase the units of the product. So then, what are the 3 major classifications of a variance? This we already know, so you should be able to put them down quickly in your jotters. So the 3 major classifications of variance, we have the direct material cost variance. We have the direct labor cost variance, and then the overhead cost variance. So these are the 3 major classifications of variances that we have. This is further broken down into material price variance, and then material usage variance. I hope we saw this last week from our previous lesson. Then when we come to the direct labor cost variance, is also further classified or grouped into the labor rate variance, and then labor efficiency variance. But for this, we also have the efficiency and all, but our focus is on these 2, as in the direct material cost variance and then the direct labor cost variance. That's for our level. These are the main 2 we'll be looking at. Now, when we talk about this, we are looking at the price. Here, we are looking at the quantity of materials to be used, right? So the variance will be cost as measured against the quantity. Here, we are looking at the quantity as measured against the standard price set. Here, when we come to the labor rate, we are looking at the rate we are supposed to pay our employees per hour. And then here we are looking at what the number of hours we expected to spend in production. So these are the 4 main focus here. We are going to look at the direct material cost variance, which is further broken down into material price variance, and then material usage variance. And then when we look at the direct labor cost variance, it has also been broken down or grouped into direct labor rate variance and then direct labor efficiency variance. I hope this is a quick revision for you. You have recorded the types we have under variance. So we will look at a calculating question to see how to calculate for the various variances stated. So let's take a question. From our previous lesson, we only look at a question just for material and then a question just for labor. This time, this is a full question. When you are supposed to be evaluated in your examination and there is a full question, how do you go about it and pick your details? Understanding the question is part of the solution, and even how to be able to pick your details is also part of understanding the question. So let's look at this question. Fred and Sons produces one standard product called OSA. The following standards have been given. Materials. So don't forget this. One standard product called OSA. So this cost stated here is for just one product. The following standards have been given. We have materials. 12 kg at 30 given as here. So for each unit we produce, we are going to use what? 12 kg of the materials. I hope that is clear. Then labor, we have 9 hours. For 1 unit, we are going to use what? 9 hours at 25 naira, which will give us a total of 225. For the first quarter of the year 2015, 1,500 units were produced. A total of 19,750 kg of materials were bought at a total cost of this. Please don't forget, this is the actual materials purchased, and that is the total cost we incurred. A total of 636,850 was paid for wages for 13,550 labor hours used in the period. Please put your important details down. So we have the actual materials purchased, the cost that was incurred in purchasing these actual materials. We have a total of 636,850, which is the actual amount paid as wages for 13,550 hours used in the period. I hope we are taking note of these details. Materials issued to production was 18,500 kg. I hope we all have our details ready. If you have them, then your calculators and your jotters should also be ready as well. Let's go to our worksheet and then look at how we can best calculate for the various variances with regards to this question. So this is the requirement of our question. We are supposed to calculate material price variance, material usage variance, material cost variance, labor rate variance, and then labor efficiency variance. I hope we can do this. All right, so let me walk you through. Material price variance. From our previous lesson, we already know this. So what is the formula for calculating for material price variance? You should be able to code that in your book now. Good. So the formula for calculating material price variance is actual quantity into bracket standard price less actual price. Actual quantity into bracket standard price less actual price. Why are we having actual quantity standing out? From our previous lesson, we stated that the material price variance is equal to the standard price multiplying actual quantity. I'm using the abbreviation. Then we less our actual price multiplying actual quantity. So this is the formula for material price variance. And we realize that actual quantity is multiplying both the standard price and then the actual price. So to simplify our formula, we can just make the standard quantity stand on its own, then multiply through the standard price and then the actual price. I hope that is clear. Good. Now we know our formula. Let's look at our details. What is our actual quantity from the question? From the question, we have been given our actual quantity where the organization purchased. The organization purchased 19,500 kg of materials. So we have 19,500 kg was purchased or bought. Then 18,500 of these materials were issued to production. The actual materials produced was 1,500. That is production. All right. So with these three details here, the organization produced 1,500 units. Before they could produce this 1,500 units, they made purchase of 19,500 kg of materials to be used in production. But they only issued 18,500 materials to production. What will be the actual quantity of materials used? So let's look at both. Though they purchased 19,500, all the 19,500 materials weren't issued out to production, right? So we have the actual quantity being used to produce this 1,500 as the 18,500 kg of materials. So though they made purchase of 19,500, they only issued 18,500 kg for production. So for our actual quantity, it is the 18,500 kg that was issued out to production. Then our standard price was stated in the question as 30 cedis, but the actual price wasn't given. How do we ascertain the actual price? They purchased 19,500 kg of materials and the total cost incurred was stated for the total 19,500 units purchased. So to know the total actual price for just one item, we divide the total cost by the quantity they purchased, which will give us the actual price of 62 naira. So let's compare. Is the actual price higher than the standard, or the standard is more than the actual price? We are seeing the standard price as 30 and then the actual price is 60, meaning the actual price is even more than what they expected to purchase the unit of material, meaning we are going to have what? A negative variance. So let's multiply the actual quantity with the difference between the standard price and then the actual price. So 30, which is the standard price, from the actual price of 62, will give us a difference of 32. We multiply to arrive at a cost of 592,000 adverse. It is adverse because the actual price is more than the standard price. So that is our material price variance. Let's look at our material usage variance. So you put your details down. This is the amount of material we purchased, 19,750, and the cost is 1,224,500. But just 18,000 was sent out for production. Now, what is the number of kg that will be used in producing just one unit? We have 12.5 kg. That is for the standard set. For each unit they will produce, they will use 12.5 kg. And the organization produced how many units? We have 1,500. What would be the total standard of material they would have used in producing this 1,500? The firm only set a standard for just one unit, but there is a production of what? 1,500. How do we ascertain the standard quantity used? So let's look at how best we can calculate for that as well. What is the formula for calculating the material usage variance from our previous lesson? You should know this by now. We have the standard price multiplying the standard quantity less our actual quantity. And then the standard price have been given For each 12.5 kg they will use for 1 unit, the standard price is 30. So we already know the standard price as 30 naira. And then for the standard quantity, how do we arrive at the standard quantity? For each unit to be produced, we are going to use 12.5 kg, right? And then we have produced 1,500 units. What is the quantity of material that will be used in producing the 1,000? That's the standard. You already know the actual quantity they use in production, but what would have been the standard material the organization estimated to use for the 1,500 units? So if 1 unit is 12.5, then what will 1,500 units be? So we multiply the 1,500 units produced by the 12.5 kg, and that will give us 18,750 kg of materials. So that is what the firm sets to use in producing the 1,005. That is what they were expecting to use, but the actual materials used was what? 18,500. So we compare both. The actual is 18,750, sorry, the standard, and then the actual is 18,500, which is the total quantity they issued out to production, though they purchased 19,750. I hope that is clear. Good. So we compare both. There is a difference of 250. And is this 250 positive or negative? It is favorable because the standard quantity the organization had wanted to use in producing is more than the actual. It means they use less materials in producing the 1,500. Good. So we multiply the standard price by the difference between the standard quantity and then the actual quantity. And that will also give us a cost of 7,500 naira, and that is favorable. As I said earlier, it is favorable because the actual quantity used in producing is lesser than the standard quantity they estimated to use in production. I hope we are good. All right, now let's look at the next requirements. We are also asked to calculate for the labor cost. But before then, let's look at the total material cost variance, which is addition of the price variance and then the usage variance, or our standard cost with our actual cost. We already know our material price variance, which we've already calculated for. We add our material usage variance to that, and that will give us 592,000 adverse. It is adverse because the material price was adverse, which is way higher than the usage variance, which was a favorable variance, because we are adding the two, and that will give us the material cost variance. Now let's look at our labor cost variance. For the labor, it means our focus is going to be on what I talk about, the efficiency and the rates. We are looking at the rate to be paid for each hour spent on the job. Now, a total of 636,850 was paid as wages for 13,550 hours spent in producing the product. Now, for each unit we produce, we was stated here that we are using what, 9 hours, and that is the standard cost of what, 25. That is the rate for the 9 hours. So we want to know the total we are supposed to incur for the standard. We do not know the standard hours to be used in producing this same 1,500 units. So let's look at our labor cost variance. I hope you have your details written down. A total cost of 636,850, paid for 13,550 hours. Then we have the standard hours of 9 at a rate of 25. So the first one is our labor cost variance. What is the formula? All right, so for labor efficiency, we have our actual hours, it's bracket standard rate less actual rates. Now, what is the actual hours given in the question? We said a wages of 636 was paid for 13,550 hours. So the 13,550 hours is the actual hours used in producing the 1,500 units. The standard rate stated was 25. Now, how do we ascertain the actual rate, which has not been given? The firm paid 636,650, and then for how many hours? 13,550 hours. What will be the rate for just 1 hour? That's what we are looking at. So we divide the total cost by the number of hours spent in producing the product, and that will give us the 47 as you are seeing here, because the 47 you wouldn't see it in your question. You have to do your own calculation. You know the total cost for the total hours used in producing. So you divide the cost by the number of hours spent in production, and that will give you the actual rate of 47 cedis. Now let's compare. Is the standard rate more than the actual, or the actual is more than the standard? We have the standard rate as 25. Standard rate as 25, and then the actual as 47, meaning the actual rate is more than the standard rate. Right, 25 compared to 47, meaning the actual, which is the 47, is more than the standard, which is 25. So we multiply the actual hours by the difference between the standard rate and then the actual rate, giving us the 13,500 hours multiplied by 22 naira, which is the rate, the difference between the two rates. And then we have a cost of 298,100 adverse. And you already know why it is adverse, right? It is adverse because our actual rate is more than the expected rate for the number of hours we spent on the job. I hope this is too easy to calculate for a particular firm. Now let's look at the other requirements. So we've looked at the labor rate variance. Now, what is the labor efficiency variance? That is our standard rate multiplying the standard hour less the actual hours. What is the standard rate? It has been given. We already know the standard rate as 25 naira. Now, what is the standard hours which the organization estimated to use in production? It has not been given, but what is the total units produced, which is 1,500 units? And how many hours per unit? We have 9 hours. So you multiply this 9 hours by the 1,500 units to know the total hours that would have been used in producing the 1,500 units. And that gave us our 13,500 hours. So that is how we came by the standard hours. We know the actual hours have been given, but as to the standard hours, we are only giving the standard for just 1 unit. Now, a total of 1,500 units has been produced. How many hours would have been used for producing this 1,500? That is the standard we are looking at. So you multiply the standard for just 1 unit by the total units produced, which is the 1,500 multiplied by the 9 hours, and that gave us a total standard hours of 13,500. And we already know our actual hours which was used in production, because the firm paid the 660 for the 13 hours, 550 hours work. So that is the actual hours used in production. We compare. Our actual hours is 13,550, and then the standard hours is 13,500. Is there a difference between the two? Yes. The standard hours the firm was expecting to use in production is lesser than the actual hours used in production, which is 13,500. So the actual hours is more, meaning there's going to be what? A favorable cost. What they were expecting to use in production is lesser than, there's going to be an adverse because the actual is more than the standard. So we multiply the standard rate against the difference between the standard hours and then the actual hours used in producing the 1,500 units. So we have the 25 naira multiplying through the difference, which is just 50 hours SS. So we have our cost of 1,250, and this cost is adverse. It's adverse because the actual hours used in production is more than the standard hours they were expecting to use in production. I hope that is clear. All right. So we take a second question. I hope this will be too easy for you to follow with the understanding of our first illustration. Now let's go through our questions. As we read, you take note of your important details and then you note them down, as the questions will be on your screens for just some few minutes. The data below relates to the standard and actual results of a product. Standard per unit of the product, we have the direct material used in production as 80 kg. So for each unit produced, 80 kg is used for each unit, and the cost is 70. That is the price per unit is 70 pesos. The direct labor is 20 hours at a rate of 1 cedis. Production of IS is 12 cedis. Standard cost per unit, we have a total of 88 cedis, which we wouldn't even need in our calculation. Take note of the important details. The 80 kg at a price of 70 pesos, and then the 20 hours at a rate of 1 cedi. Take note of those details. Now let's look at the actual results for September. The direct labor costs, we have 2,125 for 4,250 hours. The cost incurred on our workers is 2,125 for a total hours of 4,250. Then we have the opening stock of direct material, which is 3,250, meaning there is a stock in our stores from the previous month, which you have to take into consideration. Then we have direct material purchase, which is 14,500 kg, and it costs the firm 4,205. The closing stock of direct material is 15,000 kg, and then the production unit is 375. This Also an important figure you have to take note. This is the actual unit the firm has produced. Now, we have an opening balance, we have a closing balance, and we have material purchase. We have to consider all these three in our calculation. Now, the firm made a purchase of 14,500 kg. As you can see on your screens, this is what the firm purchased for production. But there was an opening balance. There was an opening balance of 3,250. And the firm is expecting that after production, you are supposed to still have a balance of the materials in your stores, which is our 15,000. So we have closing balance of 15,000 kg. So we have open balance of this, and we made purchase of this. But the question says at the end of production, you are supposed to leave this quantity of materials in your stores. So you need to consider this. We add our opening stock to our purchase to know the total quantity of materials we have. And then we are supposed to leave this amount, 1,500 kg, in our stores. kg. So the opening balance added to the purchase of material will give us 17,750. So we have this total 17,750. That is 14,500 plus the 3,250. So now this is the total material we have in our stores, and we are expected to leave this quantity by the end of production. So you subtract the closing balance from the total material we are having in our stores, and that will give us our actual quantity we are going to use in production. We already have an opening balance, meaning there were some materials existing in our stores before we made purchase of extra materials, giving us this total. Now the question says there should be a closing balance at the end of the period. So it means all this total material, you cannot use all in production. So what was the actual materials used in production? You have to subtract your closing balance from the total material. That is the addition of the opening balance and then the material purchase to give us our actual quantity of material used in production. All right. So if you understand it this way, then let's go back to our worksheet and then calculate for the various variances being asked. So these are requirements. We are supposed to calculate for direct material cost variance, direct material price variance, direct material quantity variance, direct labor cost variance, direct labor rates variance, and then direct labor efficiency variance. So get your calculators ready and then let's get busy. So we have the first requirement as our direct material cost variance, which is the standard price multiplying the standard quantity less the actual price multiplying the actual quantity used in production. Now, what is our standard price? Our standard price has been given in the question as 70 pesos per unit. But how do we ascertain the standard quantity, right? For each unit produced, we are given the quantity to be used, which is the 8 per unit. And then the quantity produced was 375. So we multiply the total quantity produced by the unit we are supposed to use per each unit produced, the material, the kg, that we are supposed to use in production. So for each unit we produce, we're given a total quantity of materials we would need in production. We multiply that by the total units produced to give us the standard quantity, and that is how we arrive at this 30,000. Then we have the actual price for each quantity used at 0.29. How do we ascertain that too? We made the purchase of materials of 14,500 at a cost of 4,250. So we divide the cost of 4,250 by the actual materials we purchased, not the material we used, the material we purchased, which is the 14,500, and that gave us the 0.29 cedis. And then the actual quantity used, as I explained, we had an opening balance of 3,750, which was already in our stores. Then we made purchase of 14,500. We bought 14,500. There is an opening balance of 3,750. So we add this, and then we subtract the closing balance of 1,500. So that will give us our actual quantity. Though we made a purchase of 14,500, the question is asking us to keep some of the materials in the stores at the end of production. So you need to consider that. And the materials that was already existing in our stores, we have to use it, because that is from the previous month. If you don't use it, it may get spoiled. So you have to use that material in addition to what you have purchased. So we add the opening balance to what we bought to give us the total quantity we are having now. But then we still want to keep some materials for the subsequent month, and that is 1,500. So we add the opening balance to the material we purchased, then we less the closing balance. That is why you are seeing the 16,250. So though we purchased 14,500, that is not our actual quantity used in production, but our actual quantity is the summation of the opening balance and what we made purchase of, less our closing balance of 1,500. So that is how we arrived at the actual quantity of 16,250. Now let's compare. We multiply the standard price by the standard quantity, giving us 21,000, and then the actual price by the actual quantity used, also giving us 4,712.50 pesos. So then we subtract, and that will give us a difference of 16,287,000.50 favorable. Why is it favorable? Because the actual is very less than the standard cost. The standard cost is 21,000 and the actual cost is 4,712, where the actual is less than the standard cost. It means what the cost is what's favorable to the firm. So that is our first requirement, our direct material cost variance. Now let's look at the next one. We are asked to calculate for the price and usage variance for the firm. And this price and usage falls under the direct material cost variance. What is the formula? By now, the formula, you should get used to it. When we are looking at price, it means standard quantity will stand out, and then we compare the standard price and then the actual price. The actual quantity has been given. We've already done our calculations to ascertain our standard quantity. So when we get here, it should be easy for you, where we look at the opening plus what we purchased, and then we less our closing balance. It's not every question that will be stated in that form, when they purchase material and there's no other clauses whether some were issued or not, it means the total material they bought is your actual quantity. If they also buy materials and some were issued to production, then what they issue for production becomes your actual quantity. So always look at the details of the question to determine your actual quantity used in producing. But with this question, we have some materials already in our stores where we also have to use it in production. And then we added up, yet we are supposed to leave some materials in our stores. So that is how we ascertain our actual quantity with regards to this particular question. So we already know our actual quantity as 16,250. And then our standard price was stated as 70 pesos. Then the actual price, where we also divided the actual costs we incurred in purchasing the material of 14,500. So we divided the cost incurred by the quantity we purchased, and that gave us the 0.29 pesos as the actual price. So we compare, we have the actual price as 29 pesos and then the standard price as 70. Would this be favorable? That's the first question you should ask. When you compare the two prices, is it favorable or adverse? I'm sure you've answered that yourself. Once the actual price is 29 as compared to the standard price of 70 pesos, it means the actual price is less than the standard price, meaning our costs will be favorable because what they estimated to purchase the material is even way higher than the actual price they purchased the material on the market. So we compare the two and then we multiply our actual quantity by the difference of 0.41 pesos. And that will give us a total cost of 6,662, which is favorable. And I know by now you know why it is favorable to the firm. It is favorable because our actual price is less than the standard price. I hope this is too easy now for you to calculate. Now let's look at the other aspect of our direct material cost variance. We have looked at the price, and the next one is to look at the usage. Now, what is the usage? The formula for calculating for material usage variance. We have standard price standing out, and then multiplying through standard quantity less actual quantity. I hope you can expand it knowing the actual formula. Now, what is our standard price? By our question, our standard price was 0.70 pesos. Then how do we ascertain the standard quantity? We've already looked at how to ascertain it. We said for each unit we will produce, 1 unit is equal to what? 80 kg. Now they made production of 372. For this total quantity produced, the first question is what would have been the standard quantity they would have used in producing this quantity? So you multiply the 372 units produced by this 80 kg. So for each unit, they would have used 80 kg, but for the 372 units they produced, we don't know the standard quantity they would have used in producing it. So to ascertain that, we multiply the unit they have produced by the 80 kg, and that gave us a 30,000 kg of materials to be used in production. You already know the actual quantity. I hope you recall how we arrived at that. That is adding our opening to what we purchased and then lessen the closing balance, which gave us an actual quantity used as 16,250. Your next question should be, which one is more than the other? The standard quantity is 30,000. That's what they estimated to use. But the actual quantity used is 16,250. Is it more or less? All right, so we can see that our actual quantity is less than the standard quantity. So definitely we are going to have what? A favorable variance. So we multiply our standard price of 0.70 pesos by the difference between the standard quantity and that of the actual quantity. So that will give us 0.7 multiplying 13,750, giving us a total cost of 625 favorable. And yet we know why it is favorable, because our actual is less than our standard price. All right, so we look at the labor cost variance. So this time around, our focus is going to be on the hours used in producing the product. If you have 20 hours at a rate of 1 cedi, that is the standard organization set, that they are going to use 20 hours and the rate will be what? 1 cedi for each hour used in production. Now, the total cost of 2,125 was paid for 4,250 hours. Total cost of 2,125 was paid for 4,250 hours. And we know the unit produced is what? 375. You take note of this detail. This is what we are going to be using in calculating for the labor cost variance. Now let's go back to our worksheet with the details we have down. So direct labor cost variance, what is the formula for calculating for direct labor cost variance? You should be able to put this down in your jotters with the little examples we have solved today. By now you should have the formulas at your fingertips. So we have standard rate multiplying standard hours less actual rate multiplied by this actual hours as the formula for calculating our direct labor cost variance. What is the standard rate? It has been stated in the question that 1 cedi is the rate per hour. So we have 1 cedi as our standard rate for each hour spent, each 1 hour spent. Now, what is the standard hours? We said for each unit produced, we are going to use 9 hours. What is the total units produced? We have 375 units. We know for 1 unit, but how many hours would have been used to produce the 375 units? So that's the first question. That's the standard the firm have set. They will use 9 hours. But the total production is what? 375. So what would have been the hours spent in producing this 375 units? So you multiply the 9 hours by the 375, and that gave us the standard hours of 7,500 hours. Now the actual rate, how do we ascertain the actual rate? A total of 2,125 was paid for 4,000 hours, 4,000 some coins hours. When we go back, I hope you have your details down so that we can refer to the actual hours worked for. We divide the cost incurred for these hours to know our actual rate. The actual rate has not been given in the question, but we know the total cost incurred per the number of hours used in production. So we divide the cost by the rate to the cost by the number of hours to arrive by at the actual rate. And then we already know the actual hours they use, which is the 4,250 hours. We go further. We multiply the 1 cedi by the 7,500 hours to give us 7,500 cedis. And then the actual cost is also the actual rate multiplied by the actual hours, which will give us a cost of 1,912. When you get here, you always have to compare and know whether it is adverse or favorable. Now we have the actual cost as 1,912, And then the standard cost are 7,500. Is this favorable or adverse? Good. I hope you have your answers written down. So we do the subtraction and we have a total direct labor cost of 5,587 favorable. It is favorable because they would have spent more, but they have rather saved what 5,587, which is favorable to them because the actual cost incurred is less than the standard cost incurred. Now, so let's look at the other requirements where we are looking at the efficiency and rate variance under the direct labor cost variance. So the direct labor rate of pay variance, which is the rate variance, is equal to the actual hours into bracket standard rate less actual rate. Standard rate less actual rate. We already know our actual hours used, which is the 4,250 hours. Then the standard rate was given in the question as 1 cedi for each hour spent on the job. Then the actual rate is 0.45. How do we ascertain this? We multiply the total cost incurred on our workers pay the number of hours they spent on the job. The total cost divided by the actual hours spent give us the 0.45 pesos. Now let's compare the two. Is it high or low? Which one is more than the other? The standard rate they were expecting to pay for each hour work on the job is 1 cedi, but the actual rate they paid was 0.45, meaning the standard is higher than the actual rate. So there's going to be what? A favorable, because the actual is less than the standard rate. So we multiply the actual hours by the difference between the standard rate and then the actual rate, giving us a total of 2,337.50 favorable costs. And as you already know, by now you should be flowing why it is favorable and then why it is adverse. Now let's look at the last one, which is the labor efficiency variance. If you still don't have your data, you can just go through quickly and then put your data down. We are working with an actual number of hours and the cost incurred, and then the total units produced. We have 20 hours and then 1 cedi. So we look at the last aspect of it, which is the direct efficiency variance. And that is calculated by standard rate into bracket standard hour less actual hours. What is our standard rate? It has been given as what? 1 cedi. And then our standard hours is a multiplication of the 20 hours we are supposed to use in production, multiplied by the total units produced as 375, which gave us this 7,500. And then our actual hours used have been given as 4,250. We compare the two, we realize that our actual hours is also less than the standard hours, because the standard is 7,500 and then the actual hours is 4,250. So automatically this is favoring the firm. So we look at the difference, then we multiply by the standard rate of 1 cedi. And that gave us a total of 3,250 favorable. It is very favorable because our standard is way higher than the actual variance. So before we go, or too soon, we have come to the end of our lesson. But you always have to keep yourself busy trying to solve questions to help you understand what you've learned better. So before we go, let's quickly look at this following question, which will help you when you have your free periods. Define standard costing. You should also say the major classification of variances, which we have already looked at. We said we have the labor cost variance, we have the direct material cost variance, and then the overheads variance. But per hour level, our focus is on the labor variance and then the material cost variance. So you have this question to help you understand what we have done so far. The data below relates to the production of Kiket products. Standard per unit of the product, we have direct material 200 kg at 3, direct labor 50 hours at 1 cedi. Then the actual cost for the month, we have direct labor cost as 7,500 hours, which costs 15,000 cedis. Opening stock of direct material is 6,500. Direct material purchase is 29,000, which costs 58,000 cedis. And then the total units produced is 500 units. You are required to calculate the material cost variance, the material price variance, the material quantity variance, labor cost variance, labor rate variance, and then labor efficiency variance. Okay, so to my business gurus, this is where we bring our lesson to a close. And don't always forget that until you practice, you can never be a good student. So until we meet again, I still remain your favorite costing teacher, Madam Juliet. Enjoy your day.
Subscribe to our YouTube channel, Joy Learning TV.